Hello, this is Mike Swanson of Wall Street Window. I've got a very special guest with me today. I'm speaking with Ike Iossif, who runs the website marketviews.tv. How you doing today, Ike?
I'm doing well, Mike. Thank you. How about yourself?
Oh, I'm doing good, and thanks for taking the time to talk to me and everyone else. We did an interview just the other week, and we're going to do a follow-up interview today and go into some real detail on what your indicators are showing with the stock market. There's a lot of debate right now. Is this a pause we've seen since January, or is this a bear market, or we're going to break up or down and so forth? So it'd be real interesting to see what your thoughts are and what's happening.
Well, Mike, let's go back to what we have said since the beginning of the year, kind of like bring everybody up to speed. We did an interview on January 15th. For me, it was part 2 of 3 of the quarterly report that I did for my subscribers. And at that time, I had said that the 2875, 2905 zone was going to be the first real important resistance for 2018 and probably an important turning point. As it turned out, the S&P tapped out just 11 days later on the 26th of January at 2872, just 3 points below 2875. Following that, on February 6th, I alerted our subscribers that the first important support zone was going to be at 2585, 2565, and the one next was at 25, 25, 2515. And if the first did not hold, then traders should be looking for a credible balance from the second one, between 25, 25 and 25, 15. Well, the S&P bottomed out at 25, 32, just 7 points above the 25, 25 support zone. Okay. And then following that, in the report that I issued on March 12th, I highlighted that since both the first important resistance zones that we had for the year held, the one with 2875, 2905 zone, and the first important support zone between 2525 and 2515 also had held, the analysis told me that there was a very good chance that over the next 4 to 12 weeks, 1 to 3 months, the zone of T will help. In other words, the S&P will stay between 2,500 and 2,900 for the remaining 4 to 12 weeks. And that was the chart I had shown, I had sent along with the analysis. And then on April 29th, which was just a few days ago, I pointed out that 6 weeks later, the S&P was still in that zone. And the chances were that more than likely, over the following 4 weeks, the remaining of the period, it will continue to do the same. With the exception that if over the next 2 weeks, the S&P was unable to close above the midpoint, then the odds will increase that we will see a further decline and violation of the lower support, which is at 2,500. What I would like to discuss next is why back in January I had said that the 2875, 2905 resistance is going to be a very important one. The reason is this: people who listen to us have seen that I usually show it once or twice a year a proprietary indicator that analyzes the inflows and outflows for all the stocks that go into the S&P 500. I do the same thing also for the XAU and a few other indices. The next chart is the same thing, but a little more narrow. what I do is I combine the stocks that make up the OEX and the NDX, and then I run the same analysis on the 40 most active on a daily basis. Now there is some overlapping. There are some stocks that are in the S&P 100, the OEX, and also the NDX, like Amgen and Apple and Gilead. Obviously, if it so happens that one of the common stocks is also the most active in the list, we count it once, and then we go to the next one, okay? There's no double counting. The point is, these are the inflows, outflows analysis for the 40 most active stocks on a daily basis, taken from the universe of combined OEX and the NDX. Now, when we did, right underneath I have the S&P 500, the S&P. When we did an interview, which was on the 15th of January, we can see that people actually were selling into the rally, and the inflows were making lower highs.
Oh,
now,
I see, yeah.
Let's step back and think about this. Let's say that at point A, a stock or an index, okay, is at 100, for example, okay? And at that point, 90% of the trading volume is on an uptick, only 10% is on a downtick, all right? Well, a week later, the index of the stock is at 120, and at that point, 80% of the volume is on an uptick and 20% is a downtick. We go a couple of weeks later, the index of the stock is at 130, and at that point, 70% of the volume is on an uptick and 30% on the downtick. What net, okay, so we still have more buyers than sellers, okay? So the stock on the index keeps going up. We have more demand. But at the same time, what are we observing? That the selling grows while the buying declines. Well, at some point, the two are going to have a negative crossover, okay? And the reason I said that the 2875, 2905 zone was going to be the third real test was that I extrapolated that at the rate the buying was declining, by the time we got to 2875, 2905, we would have had a negative crossover. And pretty much that is exactly what happened.
And it don't.
Okay? Yeah. Now since then, okay, the interesting thing is that the outflows and the inflows are making higher lows and lower highs, which is actually what you get within a triangle formation. But if you look at the chart, we're pretty much getting the same thing, okay? And which is supported by the inflows and outflows, which is like the dollar volume on upticks versus the dollar volume on downticks. And that, it validates the triangle that the most investors are in right now, and as well as that the 2875, 2905 area and the 2525, 2515 support. These are two levels that we really need to keep an eye on. The next issue I would like to discuss is something that I see being mentioned many times, and that is the AD line.
Okay.
The next chart is the AD line, the last 4 years, and we can see that the AD line has formed an ascending triangle. The NYA has formed a descending triangle. These formations, and I'm going to discuss them in more detail as we go on, they can be continuation patterns or reversal patterns. The argument now, and has been, is that we have never seen an important top with the 80 line being as strong as it has been? Yes and no. The actual experience shows that the 80 line by itself is a very unreliable indicator, because underneath that, I have the 80 line between 1998 and 2004. And we could see that the 80 line was declining from 98 all the way to 2000. So one could have possibly said, well, how can the market keep going up with the 80 line declining? Well, it did. And more interestingly is that the 80 line bottomed September of 2000, right at the top of the market. Okay? And it kept going up. Now,
how is that possible?
Excuse me?
Oh, how did that happen?
Well, there is a reason, and I'll explain what was happening. But what people need to get out of this is, if somebody was bullish because the 80 line was going up, okay, means he would have endured the entire bear market. In fact, the 80 line at 0.3 made its highest, it reached its highest level in 3 years, while the market was getting ready to embark on the biggest decline of the bear market. Okay? The two got in sync after 0.4, I mean after the market bottomed in March of 2003. So the point here is that the 80 line by itself is not a reliable indicator. It has to be viewed in conjunction with price.
Okay.
And price action has to be given a higher weight. I mean, after all, you cannot buy or sell 1,000 shares of the 80 line. Okay? All you can do is buy the stock or buy the index, but you cannot buy or sell or short the 80 line. So keep that in mind, that just because the 80 line is doing one thing, it doesn't necessarily mean that price has to follow. Okay? So the current strength in the 80 line, it is noteworthy, but unless price follows, it doesn't tell me anything.
Right, right.
Okay, that is the point that people need to keep in mind. And the next thing I would like to discuss is the pattern that the major indices are in right now. They are in a pattern called, they're in a triangle pattern. I have listed a link where people can read in detail about triangles. Basically, we have three kinds: ascending, descending, and symmetrical. I don't want to bore people with technical jargon here. What they need to keep in mind is that right now we have a really complex situation. If you look at the S&P, okay, lines A and B form a symmetrical triangle. And then within that large symmetrical triangle, we have a descending triangle, which is formed by lines B and C. So you have a triangle within a triangle.
Okay.
It really makes technicians pull their hair. I mean, this is a very complex pattern and unpredictable, in my view. From a technical point of view, a break above 2720, 2714 would imply that these two triangles actually, they were continuation patterns, okay? A break below 2525 would imply that the descending triangle, which is defined by line B and C, actually is a reversal pattern, and the downside target is around 2400. The question is, all right, how do we trade this? What do we do? If you try to trade a triangle, basically what we try to do is center our trade based on the breakout or the breakdown. And based upon somebody's risk tolerance or loss tolerance, we put a stop loss within 1 or 2% below or above the breakout, the breakdown level. Or what you can do is, if the stocks of the index are near the apex of the triangle, we can buy calls and puts. But you want to make sure that the pattern is near its apex. Otherwise, you can end up losing money on the options because they're going to end up worthless at expiration.
Right. So it's like a straddle trade, basically.
Exactly.
Yeah.
Okay. I have a chart of the SPY to give a real example. Right now, if you're trying to trade the SPY based on the triangle formation, okay, what you would do is you would go long on a close above 2072.5, and then you have a sell stop loss at 267.5.
Okay.
If there was a breakdown, you would go short on a close below 255, and then you would have a buy stop loss at 260. And the third option is with the SPY around 265. What you could do is you could buy calls with a strike price of 272.5 or puts with a strike price of 255, and I would go out 3 months, if not 6.
Right.
Okay? And again, I would emphasize, if the triangle, if the price is near the apex of a triangle, and then you can use options. If you don't have an opinion with regards to which way it's going to break, you can use puts and calls. But the good thing about this pattern is that it is a treble pattern. You don't really have to have a strong conviction, okay? If it breaks out, then you go long with a tight stop. If it breaks down, you go short, again with a tight stop, depending upon what your risk tolerance is. Personally, I would place the stop 1 or 2% away from the break point. On the long side, I would put it below the break point. On the downside, we put above the break point. Okay? So it gets more complicated if you are already long, 80, 90, 100%, and you got to figure out what to do. Well, what I would say is, based on the triangle, if you get a break, okay, then perhaps you may want to do some selling or some hedging.
Mm-hmm.
The interesting thing is, and we have spoken about that before, if you connect the lows of 2009 and the lows of 2016 for the S&P on a weekly basis, the support comes at 2,400. So even if we have a breakdown here and the price objective based on the size of the triangle for the S&P is 2,400, technically we will still be in a bull market because the uptrend line going back to March of 2009 would not have been violated.
Well, yeah, that's good news for people because there are people worried about a breakdown, but then at the same time, a lot of people I see are predicting a breakout, and but it doesn't, saying that it'll make new highs and just go up for the rest of the year, basically. But
well, you know how to trade this pattern. You don't really have to know which way ultimately it's going to go. You just need to know what to do if it does one thing or the other.
Well, what are some trades that you have on right now yourself?
When we had our interview on January 15th, I had said that going forward, I saw one trade that had the highest risk reward ratio. I'm sorry. And that was to short bonds. short TLT. Subsequently, I bought TBT on April 12th at 36.85. As of yesterday's close, it was at 37.93, and I have a stop at 37.15. This is the only active trade that I have. Our subscribers know that I do not trade very often. I usually do anywhere between 2 to 4 swing trades per year, and maybe one intermediate to long trade, which has a horizon of 1 to 3 years. But swing trades like this one, I only have one active trade, which is what I had said back in January. I'm short the bonds via TBT. Now, with regards to what's going on forward, I see trading opportunities both in equities and gold stocks. In fact, I anticipate that between now and the end of the year, I will probably make another 2 to 4 trades in these two asset classes. And of course, all of our subscribers will be notified via email in real time, as we always do.
And for me, those trade alerts, when you're only making a couple trades like that a year, they're critical trades that have, they're worth doing. It's not like someone trying to day trade and do risky or low probability trades. You're talking about trades that are lining up, just a couple times and really exciting to be a part of, really.
Well, I believe our subscribers can testify that for the last 3-4 years, I don't think we have had a losing swing trade.
Mm-hmm. Mm-hmm. Well, is there anything right now? I mean, with the financial markets, I have the feeling just 90% of people aren't worried or very bullish. Like the triangle pattern, as I mentioned, a lot of people are predicting a breakout and just a move straight up to the high, and basically the rest going up for the rest of the year. Do you have anything though that to caution against that, or?
We had done an interview, I believe, it was late October, early November, and at the time I had made it known, which was everybody is betting on the new tax legislation. And if everybody has bought in anticipation of the passage of the legislation, then who's going to be left to buy when it does pass?
Yeah.
It is not, I think, coincidence that the market dropped right after the tax cuts were passed.
Yeah, they did. It did.
So, I mean, here's one of the biggest reasons for the market to go up is already behind us. Another reason was that the companies will report stellar earnings, corporate earnings will be stellar. And in fact, when you look at the recent results, 80% have exceeded Q1 earning estimates.
Well, right.
So that has helped the market.
Yeah, the market's almost exactly where it was before earnings season started.
Exactly.
As we're speaking.
So you have the tax cuts that went through. It hasn't really helped the market. Stellar earnings haven't helped the market. And now we had the unemployment rate, the lowest since 2000. So, I think if you have so many good news that have not helped the market, I just cannot see what else can propel it to much higher highs.
Right. Yeah, I agree with you, but it's well, it is, to me, your money, and the right now the triangle pattern, the money flows for the buying hasn't been increasing; it's shrunk too, and so forth. So it'll be interesting to see what happens over the next couple of weeks, but. I'm more interested in getting not so much what the market's going to do the next couple of weeks, but what the trades are going to do over the rest of the year are. I'm more interested in those alerts than what the Dow does next week. And we kind of talked before we did this interview to do a special offer for people to get those alerts themselves. So I'm going to put a link to that below this video. Could you describe in a little bit what they would get if they sign up?
Well, Mike, they get my own analysis of real-time alerts in addition to the analysis we do every Wednesday, every Saturday, and the quarterly reports that have actually more than one part. And of course, they get the interviews that I do with other people who they're well-known and respected in the business. And I believe it's always great to get somebody else's point of view. So anyone who subscribes to our service, let's say that they get my stuff and also very extensive research from about 15, 20 people who are interviewed on a regular basis, like yourself.
Yeah, and I find that interesting too to listen to because, if you listen to the interviews over time, you get a feel for each person and how they're changing their viewpoints in regards to the market action, and it's very interesting to follow what's going on with all the people you interview.
One thing that I want to say is that whoever decides to subscribe, folks, there are 2 steps because we always seem to have a problem with that. After you have paid for your subscription, then you need to visit the link that we give you in order to select your own password and user ID. And if you don't do that, then you won't be able to access the site. So it's going to be a 2-step process. Please remember this.
Yeah, and if you have any trouble too, just send us an email and we'll get with you and fix it all up also. Well, thanks for talking to me and everyone else, and we'll do more interviews as the course of the year goes on.
Thank you, Mike. Have a great weekend.